In this video, traders are going to look at the inside bar breakout strategy. Stay tuned. Hey traders, a warm welcome to you. Right, so in this video, we're going to look at what the inside bar is, which you may be familiar with already, but a couple of strategies and methods for taking advantage of this candlestick pattern. All right, guys, so an inside bar, let's look at the actual pattern in a moment, but inside bar is a kind of area of congestion, of consolidation, of a breather, if you like. So if we look at the fundamental supply and demand that's going on behind the scenes, it's like, okay, yesterday was a reasonable range. Today, there's no real supply-demand imbalance enough to break the prior day's range. And so it's a kind of no man's land of, okay, everyone's watching, everyone's waiting, sellers are watching, buyers are watching, what's going to happen next, where's it going to go? And it's a pause. Now, in certain circumstances, which we'll look at in a moment, completely useless. There's no edge in it whatsoever. However, in others, that little pause is a precursor potentially for an explosive move in a continuation of the trend or a reversal, in which case, there's an opportunity for us. All right, so let's look at exactly what's going on. So really, this is an inside bar here. Basically, as long as the trade is inside the prior day's range, i.e. the high and the low, you can do the same on this candlestick. Doesn't matter if it's green, up day, down day. The point is that it's a day when the high doesn't breach the prior day's high and the low doesn't breach the prior day's low. Now, you could go one step further and say that if it's within the body, it's even more powerful, but theoretically speaking, don't need to, but it adds perhaps more power to it. If it can't even break the open or the close of the prior day, that's even more kind of indecision and pause and waiting to see what's going on. So that's the inside bar. Right, so what are the strategies we've got that we can do with this inside bar? So the idea being that what we want to do is we're making the assumption that a break of the prior day's high or a break of the prior day's low is going to be a precursor for a longer period move. And so if we see this in the right conditions in the right place, we might want to pay attention. Now, in fact, you know what, let's start off in this one here. So why is this no good? This is no good. Like this here is our inside bar. That's basically exactly that. There's our inside bar here, hasn't breached the high, hasn't breached the low. Why is that no good? Well, that's no good because ultimately we're sitting in a range. Imagine this range is going for a while. There's no real, all it is just nothing happening. There's a difference between a pause in volatility that's a precursor for a volatility expansion than just nothing is happening, guys. And if you look at summer trading or if you look at trading in the middle of the night, for example, if you're on a lower time frame, by the way, guys, this is all daily time frames. Much better on a daily time frame. This is what it's to be used for, really. But if you're looking, say, you know, like a summer trading or quiet trading period, you'll get this all the time, and it doesn't mean anything. It just means that nothing's going on. Whereas if you have the right conditions after you've had some decent move, then you have this inside bar. Then it's potentially a signal. All right, so let's just put that there. So this is one here. This is an uptrend. Nice steady uptrend, and then we get the inside bar at highs after a move up. So we've got good volume, and generally speaking, you're going to get a little shrinking volume in that inside bar. So the theory is on this, guys, is that what we want to do is you want to trade a break of that high. So this is the little pause. You might even get two inside bars, actually. You might even get another inside bar kind of over that first day. Some people call this the mother bar or the mother candle. i.e. that's the kind of one that, like a mothership, so to speak. So it's one that everything's referenced against. When it breaks out, you're going long. Now, your stop is a kind of a trailing stop with this. So what does that mean? So your stop goes under the prior day's low every day it closes. So let's say you get the breakout, for example. Let's kind of draw it on here. Can we just see on the screen yet? So let's say, bang, the next day, there's your breakout and there's your close here. So your stop now goes under here for the next day, and if it goes again, bang, your stop moves up. So every time you go, your stop's moving up. You might get 2 days of doing nothing, your stop's still there, the lowest stop position, and then eventually, bang, it breaks out and it breaks to the low and you're out of the trade. Okay, so you're trailing the stop up as you go, and if the market breaches that low, the last low you ratcheted it up against, actually technically speaking, you'd probably ratchet it up to here because you hadn't, even if you hadn't, you got two things you can do. If it breaks the high, you can ratchet the stop up. If it doesn't break the high, you can leave it where it is. In this case, if you had ratcheted it up just because the low was there and it closed, the next day that would be your stop position here. All right, so you're moving up to the prior day's low each time. Sit and put it in simple terms. You can add a little flavor to that if you want, but just moving the stop up allows you to get on board. A volatility expansion means bang, 2, 3, 4, 5 day run, and you're sliding that stop up, so eventually you'll get pinged out, but only when it breaches that prior day. This is quite a nice way of trading that stop. All right, so this is one we've got slightly different here. So that was the uptrend. This is when you're in a range, but we've broken out the range and this inside bar is here. Now this is where you can potentially take it in both directions. So you can go, right, I know that something's happened here. It's either going to be a fake out or a breakout, but I think that we're going to get some decent move. And this is quite nice because you don't have to guess it. Wait for the market to tell you. So it's broken through that key level at the high. We've now got an inside bar here. The next day we can say, right, if it goes above, we can go long. If it breaks below, we can go short, and we're going to assume that it's a fake out if it's short, and we can obviously drive that to the low side of that trend, that range here. If it's a breakout to the upside, we can assume it's a clean breakout and trail our stop accordingly. Now, it's always going to happen like this? No, that's why we have our stop loss. But this is one where you don't know what's going to happen, but actually a break in either direction is something to take. Versus this one, if we've got a break to the downside here, I wouldn't want to take it because we're in a strong uptrend. I'd probably say, okay, well, let me see something else. If it breaks to the downside the next day and does that, then there's no trade on it. It has to be that break to the upside in this specific circumstance. In this one, happy to take a break to the downside because we're in a neutral market. We've tested highs. It could be just a fake out, a bull trap that reverses down and starts testing these lows. Equally, if it does that, breaks to the high here, then it's just a standard break and we can trade it and look for a volatility expansion, breakout of a range type play. Anyway guys, that is the inside bar breakout strategy. Let me know your thoughts in that comment section below. Any tweaks or adjustments you think would make this a better strategy, please let me know in the comments as well. If you like this kind of stuff, thumbs up is appreciated. And if you haven't subscribed, why have you not done it yet? See you in the next one. Take care. Bye-bye.